Hello, everyone, and welcome to a special edition of Monetary Matters. I'm excited to hand over the host chair back to Jack Farley. He is back from his vacation in Greece, and we're going to kick things off with the Fed Day episode. So, Jack, what did you think of today's press conference and the SEP and the lack of really any move from the Fed?
It's great to be back here, Max. The market was pricing in; it was a virtual certainty that the Fed wouldn't cut today. It's a special Fed meeting. We get 8 a year, but only 4 of the year we get, as you said, the SEP Summary of Economic Projections, which says what the Fed thinks about the economy, but also those dreaded or yearn for dots. The summary of economic projections showed inflation expectations going up for the Federal Reserve, which I noted was the third Fed meeting in a row that they've happened. And it's the same for core inflation, and the second meeting in a row where real GDP expectations for this year went down. At the same time, interest rate expectations went up marginally, as Nick Timiraos from the Wall Street Journal noted. There was some rearranging of the dots. So if you look, I think, at the mean average, which is not reported, it would be lower, but just by looking at the dots. But the way the Federal Reserve reports them, median, central tendency, and range, it actually looks like it was unchanged, but marginally more hawkish on the dots. So, Max, if you put those three ingredients into a cocktail of lower GDP expectations, higher inflation expectations, and more hawkish, that to me would not be particularly good for the economy or risk assets. But the market is taking it in stride, and it just goes to show that it's not 2022 anymore. The market cares about many other things other than the Federal Reserve.
I think that Chair Powell and many of the other speakers have done a very good job of hammering home the in periods of uncertainty, which we have, just an extra flavor of uncertainty now. Previously, it was just what's going on with tariffs. Now we have a war popping up in the Middle East, which could affect oil prices, many other things. But predominantly, I think people, as it relates to Fed policy, are focused on what could happen to oil prices and thus inflation, that they are going to wait and see and wait for the data to come through. Now, we did get some data in this past week. We got sort of a weak CPI print. Obviously, they use PCE, so it's a different indicator, but the market still is keenly focused on that. Did it surprise you at all that they revised inflation expectations up despite what have been pretty consistently cool inflation numbers?
I didn't really have expectations, so there were no expectations that they could be, surprised to the upside or downside. I think that actually, Max, what you said about wait and see mode, that has been accurate for the Federal Reserve for a very long time. But waiting for the data. We're going to wait for inflation to fall before we actually start cutting rates. That's been what they've been saying for many months now. But actually, inflation has been going down, and they've kind of made a slight tweak today, evident in Powell's language about we're still data dependent. They're not saying they're not data dependent, but we're also going to be forward looking. So if the 100% Buddhist monk regimen of pure data dependence of, let's say, 6 months ago was still in play, I think they might be a little bit more dovish and more inclined, if not to cut rates, to send to the market, signal to the market that they are going to cut rates. But now Powell is saying, look, yes, in the data we've seen pretty significant disinflation, but our inflation expectations are still going up because tariffs. I mean, everyone says tariffs are going to be inflationary. All of our economists and all of the economists outside of the Federal Reserve as well. So we have to be a little bit forward looking. So that is a notable shift from the Federal Reserve.
Now, the market, kind of did nothing and then started to move down after. It is hard on these Fed days. Oftentimes, there will be a question in the Fed meeting where somebody asks something, Powell gives an answer, and the market either really likes it or doesn't like it. And that's when we kind of get the post-meeting move. Simultaneously to the Fed meeting going on, you have the president, you have all of the press discussing, the war between Iran and Israel and whether it might become a war between Iran, Israel, and the United States. And so it is kind of hard to determine whether is it that statement by Powell that moved the market, or is it some statement that came from President Trump or somebody else in the administration that potentially moved markets. Do you think it was that moment? I think it was actually Tim Rose who was able to get that statement out of Powell. Or do you ascribe some of the moderate volatility more to what we're getting out of the White House and the geopolitical concerns?
At first, I thought it was the Timorous thing, but you cited some news flow. What was the thing you said before?
It was just we started to get more of the, like, Walter Bloomberg tweets about Iran. People were talking to President Trump, I think. You pointed out to me a statement he made where he's like, "I don't even know what's gonna happen." So, I think just, like, that level of uncertainty, probably more likely to have spooked the market than the subtleties of Powell indicating that they are going to wait and see even more. Now, one of the other things we like to look at coming into these meetings is what is the FedWatch tool pricing in? As we've said many times, it's not perfect, and if you're thinking about it in terms of like options pricing, it's probably not the right tool to use. But in terms of the directional accuracy of like what is the market pricing in terms of uh, rate expectations, it's very useful. We didn't see much of a move.
You're right, Max. We didn't get much of a move. It's interesting in the December 2025 contract, you actually had a marginally pricing in a little more easing, even though the dot plot was unquestionably hawkish. So that is interesting. It's almost, I mean, it's like the market doesn't really believe that the Federal Reserve is going to be uh, hold rates steady, and that maybe these tariffs are going to be less inflationary and destroying supply and more contractionary, i.e., destroying demand. That theory that tariffs are could destroy demand was referenced several times throughout the interview. But yeah, not a huge move from the bonds. Certainly not.
Now, I want to switch topics a little bit away from the Fed meeting. You obviously were spending time in Europe for the past few weeks. I'm interested for a bit of a dispatch from the ground there. There's been a lot of talk about tourism slowing down around the world, whether it's Americans not going or people not coming to the US. I'd be interested to hear if there were any anecdotal sentiment indicators about this sort of change in relations between Americans and our friends in Europe.
That's a great question, Max. I'll first start by really saying that I'm very hesitant to draw any conclusion between my own anecdotal experience or anyone else's anecdotal experience and the global, macro economy that affects the 7 billion people around the world. I'll just give an example of I think I was in some part of New York City in the summer of 2021. And I went to some restaurant and no one was there. And I'm like, oh man, recession is imminent. And of course, we were at the hottest nominal GDP growth in pretty much the nation's history, other than 2020 when it was coming out of depression. So I did that. Anecdotal evidence is completely wrong. And of course, people have taken headlines of job layoffs over the past 2 to 3 years and shown that pointed to weakness in the labor market. But in terms of the overall data, the white collar job market is not as strong.
But Jack, it's fun. Let's not
Yeah,
forget
yeah,
that.
yeah,
It's
yeah.
fun.
It is fun, but it's bullshit. But it's fun, but it's bullshit. Okay. Now that we got that out of the way, I did note some slowing in the tourism sector in Greece. One errant comment from a guy there said that I asked him like, when's the peak season for tourism in Corfu, where on the Ionian coast where I was, and he said it's normally now, but it hasn't started yet. So that could there is some weakness in the Corfu tourism sector year over year. That appears to be the case. Whether there's weakness in the Greek tourist industry or European or the global tourism industry, who knows? But that is a piece of anecdotal data that is slightly bearish. Yes.
Okay. So if we can't rely on anecdotal data such as this, the Fed has told us that they are going to be probably waiting until we get more clarity on how tariffs are going to impact the economy. When do you think the next Fed meeting of consequence is going to be, and how many points of data are we really going to have to get to before we get to um, any sort of cutting cycle?
It's a great question, Max. First, I want to highlight you talked about wait and see. By the Fed is wait and see on not acting, but by not acting itself is an act of hawkishness because interest rates are moderately restrictive. So that'll clear up that thing. I think I'm just going to I think the next Fed meeting is July 29th. Um I think there are several catalysts that are going to happen before then. First of all of the June data is going to be released in early July. So inflation and the job market is important. Uh, yeah, it's actually on July 30th. Yeah, the Fed meeting. But two more important dates actually are I think the tariff dates. July 8th is 90 days after April 9th, and August 10th is 90 days after May 12th. Those are consequential dates because April 9th is the date where President Trump gave a 90-day pause to all countries except for China. And May 12th is when he gave a 90-day pause on Chinese tariffs. So July 8th is when tariff rates are set to go back to their extremely high levels of Liberation Day, unless they reach a deal or make some sort of extension. And August 10th is when those tariff rates are set to go back on China at that also very high level, unless they make a deal. So there of course is so much uncertainty, but those are at least some dates that people, when they're mapping out their calendar for uh, economic events, I think could be quite substantial. Although it's possible, the market will move, well in advance of that, with the incoming news flow. So yeah, by July 29th, I think we're gonna have a lot more clarity. And then Jackson Hole is, I think, in August, probably after that. So I think we're the next 2 months we're gonna get a lot more clarity. Although, Max, I remember, I'm young enough to remember February 2025 when the real date was going to be April 2nd, and once April 2nd comes, then we get all of this clarity. So it's possible that President Trump, moves the goalpost or moves the ball, however you want to say it, once again, and just reaches a deal or doesn't reach a deal or gives another extension, and surprises me and everyone else in the markets once again.
We've been mostly discussing how this is going to impact interest rates and the Fed's path. But what about markets? Are you concerned at all about tariffs coming on and how that's going to impact the market?
Yes, I am. And I just want to update people on my thinking. And I could just have a dispatch every single day where I'm sharing my thinking. No one wants that. I definitely don't want that. But I do want to update people. Is that, yeah? I think the last time I shared my own views was with you, Max, and you shared your views, and I was very bearish at the time. I probably 1 week after that, you know got a lot more constructive on the market because I pretty much realized that the market is sniffing out that these tariffs are going to be a nothing burger, and I changed my view accordingly. But I am worried about July and August because of these tariff rates. So unclear if this will be a reprieve. Yeah, it's just so hard to read Trump. I thought I read Trump correctly, and I did for a few days in April. But then he pulled the ball, and the 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 tariff rates were lowered, and there was a 90-day extension to 10%. And again, 10% a year ago would seem super high, but of course, Trump has conditioned us and every other market participant like a Pavlovian dog that 10% actually is super low because you're not comparing 10% to 0 or 2%, you're comparing 10% to 145% on tariffs. So the real art of the deal that Trump has done is not with China or Europe, it's with investors in the US equity and bond market. And he's played that game quite well.
I had the great pleasure of getting to sit in and host Monetary Matters for 2 episodes while you were gone. One episode that came out earlier today with Mike Green, and another episode with Vincent DeLuard from StoneX. And Vincent said he thinks that we're going to get some market turmoil in July as those tariffs come back online, but also that we are entering into sort of the earnings blackout period when companies cannot do buybacks, and that the buybacks have been extremely important for sort of keeping the market afloat over the course of the year. And so for getting this news, and this was all sort of prior to the Israel and Iran conflict breaking out, so we have just an extra flavor of risk on top of those things that Vincent was citing. Mike was very bearish on the economy, but as he also pointed out, we have now reached over 50% passive, and the if the flows continue to come in to passive investment vehicles, it's going to be very, very hard for the market to have any sort of sustained downward movement. There might be dips here and there, but as long as money is going into passive, that's probably not going to falter too much. And one of the other things that I thought was really interesting was that the ETF flows are actually it's not like there's like new money coming in. It's a lot of people selling out of, like, active mutual funds.
Mm.
So, the net flows into the market are relatively benign, but it's that the dollar is leaving an active mutual fund manager who owns a bunch of value stocks that are not nearly as impacted by this passive multiplier phenomenon, and entering into ETFs and indices where, the stocks that are highly price, inelastic, I guess, are being driven higher by those dollars despite the flows being relatively flat.
Yeah, but my question there is, why is it that Microsoft has a market cap of, 2 to $3 trillion, maybe actually more than $3 trillion, and, the value company that the poor active manager is forced to sell has a market cap of $600 million? Is it because of just flows and unfairness? Or could it be perhaps that Microsoft is maybe a better company and has grown its earnings so much more than that company over over the past 30 years? That would be my
Yeah, well, I don't think he or I would dispute that, but the argument could be made that you know, what also something that he and Vincent agreed upon was the, sort of permanently higher, plateau of multiples.
Mhm.
And so it's not that Microsoft isn't on top of the index and getting all of these flows because it doesn't deserve it. It's that the price that people are willing to pay for Microsoft, and arguably maybe not willing to, but have to pay to get access to that quality, um, is going to be higher. And if you are waiting for it to get cheaper, that might not happen. That is until, at least as Mike says, until the flows reverse. And that's just a demographic question because, the old people own all of the assets.
Yes, and I mean, I the S&P does have a disadvantage of it does get stocks when they're that enter the index once they just had a huge run up. For example, Palantir, which I believe is on a trailing month basis, I think trading at 700 times earnings, um, is just entered the index, and obviously it would have been a great time to buy Palantir, before the huge bull run it's been on. But yeah, I'm not particularly bullish on a stock that is, even on trailing time 700 times earnings, even if it is growing at a fantastic rate with profit margins, which of course it is. I don't know, Max. I read a book. I read several books on vacation, but I did read a book about Nvidia called the Thinking Machine and the Microchip. And I don't know. I mean, just if you look at a chart of Nvidia's profit and revenue growth, I mean, I think that's something a little going on there. That's not just passive flows, but I do get the point, and I also think the Mag Seven is I mean, of the Mag 7, the ones I like the least would be Tesla and Apple and Amazon. I don't really understand Amazon as well, but, like, other companies of the Mag 7, they look pretty good to me. And, I mean, what you're gonna buy, Microsoft's growing at 20%, and it has a multiple way cheaper than Costco at seventy times earnings. I mean, I think there are, yeah, if these companies weren't growing, of course, they'd be super overvalued, and the valuation is historically expensive. But, with the growth, I don't think they're ridiculous, especially Nvidia. The question of Nvidia is it cyclical like semiconductors have been in the past, or are we in this new super cycle? Now, anytime, look, Max, I'm young, you're young, so we don't have a huge sample size, but literally anytime I've encountered the phrase super cycle, it's always ended badly. Commodities and crypto, it's all, and it ended in a huge disaster. So yeah, I once people start using the phrase super cycle for AI, that's when I'll start to turn bearish. But yeah, I mean, Nvidia's clients are incredibly well capitalized companies, and they don't seem to be reducing their spending. One thing on the I think, Max, it's like, everyone loves Broadcom now. I haven't really looked into it that much, but you know, like, a lot of the companies have a higher multiple than Nvidia, but they're growing so much slower. I'm like, what's going on? What's the argument? But yeah, I just do feel like I've got a slightly, you know, better understanding of, after reading that book, just of the chip world. And I mean, I literally knew zero about that in, the spring of 2023 when I first interviewed Citrini, when Nvidia was, not at the current level it is now, or any of these other AI stocks. But I'm kind of gradually learning a little bit. By the way, if people are interested in AI, like, obviously, Van Eck, a sponsor of the show, does have a product that has done quite well. But yeah, I think, Max, I don't know. I think people are maybe a little too bearish on AI. I'm not saying that be bullish, but I'm saying, maybe be a little too bearish.
Well, I certainly, like, am generally a skeptic, especially when things go up a lot, like,
So
it's
am I,
really
totally, yeah.
yeah, it's just naturally my reaction, that is my gut, something, like, I'm almost kind of working on, but all oftentimes when you start, quote, unquote, like, "working on that," it's, like, close to the top, right? So that's also, like, an indicator for me that when I start questioning my priors, like, well, is there a reason why? Um, but,
Wait,
you know
Max, what do you mean?
well, for instance, like, Jack, you and I, we worked together at Real Vision, and remember in 2021, we were working
Yes.
on this content campaign, and the content campaign originally was like, "Is this a giant bubble?" And there was all of this talk, like, Kathy Wood was out
Yeah,
everywhere, and, the campaign shifted to be like, "Is everything a bubble, or is that the wrong question? And this is the new, the
yeah.
new age of prosperity."
And Max,
And
the background is you and I both thought it was a bubble, and I believe you came up with that idea of, "Is it a bubble?"
look, there were a lot of people calling that period a bubble, but
Yeah,
either way, at that same time, you had a lot of people who had made a lot of money and people who, beyond Kathy Wood is easy to kick while she's down, but there are plenty of other people who are still, highly respected, who were basically betting on this thing, uh, betting on this thing continuing up and to the right. And, we all had to ask ourselves, like, is is technology changing the world? Like, and, some of those companies are still down, 90 plus percent. Obviously, tech sold off quite a bit in 2022, but here we are, way higher for a lot of those names. So it does matter. And I guess what I'm trying to get into on the AI side is you read that book. I interviewed Val Zlatov, who is the CIO and founder of a hedge fund called Analog Century Capital Management. Analog Century, they're about, a little over 2, I think it's $2 billion now. They got some money recently from Millennium, and they trade exclusively hard tech. So most of hard tech is semiconductors. These are guys who they have been following these sectors since before the AI megatrend. They understand the cyclicality in this, and even they were saying like, we don't really think that this is going to be cyclical like that. And as well, Val had been around in 2000, and he made the argument that the sort of 2000 analogy with like fiber is just not correct, and that he puts it more in cloud. So, if you remember, there was as the Mag 7, which at the time it was the FANG stocks were marching higher, people were like, How is Amazon worth all this? It's a store. The margins on their products are not that good." And in the background, what was really driving Amazon higher was their cloud business. And there's, just a lot of arguments that like cloud eventually the cloud spend would have to come down. And here we are, almost a decade later, and the cloud spend has just continued to march like up and to the right. And his argument is that the analogy for AI is actually much closer to cloud. He makes it more eloquently than I do, despite English being his second language. Probably maybe even like his third. I don't know. So I would recommend everybody go listen to that interview if you, like me, are somebody who missed NVIDIA on the way up, missed a lot of these AI stocks, and you're wondering, did I miss it all, or is this truly like a mega trend that is going to go higher? I mean, I don't know if you saw the commentary around Cotu's, like,
I did actually, yeah. I'm glad you brought let's talk about that. Go ahead, go ahead.
yeah, so they're the 40 stocks that they think are, and they gave their market cap predictions for 2030, and I think NVIDIA was in the top 5. Microsoft, I believe, topped the list. Um, Broadcom, I think, was in the top 10. I mean, here, let's get it pulled
Yeah.
up. Cotu 40, which,
Called the Fantastic 40, yeah.
yeah, Cotu's Fantastic 40, which is like super ironic because uh going back to this 2021 period, there's a guy who I went to go work for. His name's Harris Kupperman, and he wrote a piece about the Tiger 40. So during this period, you obviously had Kathy Wood with all of those names like powering higher. And then there were maybe a group of higher quality software names that were owned by Chase Coleman and Tiger Global. And he wrote this piece about the Tiger 40 that's like, hey, once all this like SPAC, like total garbage blows up and the tide comes out, like there are actually 40 companies, and these are companies that make money. They have customers. Like they're not the SPAC garbage that is really emblematic of the bubble, but these things are ridiculously overpriced too. And there's a lot of people who own both of these types of companies. And as these other names get hurt, it's going to come back here too. So it's just ironic that here we are making analogies and comparisons to this other period. And Chamath just today tweeting like, should I launch a SPAC? Goldman dropped their ban on SPACs. So here we are in 2025, and history doesn't always repeat, but it definitely rhymes.
I've got a lot of thoughts, Max. First of all, my point was that if you're a hyper bull on AI, like you're there are a lot of people who are a huge believer in AI, but they are diversifying their bets, and they're like, "Oh, Nvidia is so 2023." I mean, you got to get into. I mean, that's basically what Coatue did. They based on their market cap forecast for 2030, market cap of Nvidia of $5.6 trillion, and it's currently 3.5 trillion. That's a 58% gain from now until 2030. So that's a 10% a year gain. They're way more bullish on, for example, ARM Holdings. But if AI is this transformation thing, I mean, again, I've read a book at Nvidia. I haven't read a book about ARM Holdings, but I've seen the chart of ARM's financial performance, not the stock, the actual business and the revenue and the earnings. I don't know. I kind of don't buy it, but Coatue and its well remunerated researchers are definitely know so much more and are smarter than I am. But yeah, I think Nvidia is deserves its market cap in my view. Um, yeah, Max, to me, this does feel different. I mean, I in 2021 there were just objectively fake companies that were going to market with no revenue and basically just science projects as a business plan, and they lost they were just hemorrhaging money and lost money and went bankrupt. I was short one of them. To me, Max, I'm only seeing a multiple expansion in legitimate companies that dominate their industry and are growing tremendously and are profitable. The Kathy Wood stocks, it's unprofitable stocks in 2021. Um, eh, I mean, I'm
So you
not even,
could argue
yeah,
the quantum
yeah, yeah.
name, the quantum name.
It's beginning. It's beginning. The quantum bubble. I agree with Martin Shkreli. It's a bubble. I'm not a scientist. What do I know? It's either a bubble or it's going to transform computing. And like, if you have a 50 character password, it's going to be cracked. So like, who cares? But yeah, I think that's a bubble. But that bubble is 5 months old. So do bubbles last 5 months? They typically last longer. So I'd say early to middle stages of a bubble if it's a bubble. But I don't buy it. And Max, the recessionistas, I mean, the recessionistas have been singing the same song for so long. And I believe in them many times. The, I am susceptible to being convinced of a recession argument. That's negative. The positive is that I can quickly change my mind. So I've unconvinced myself of the recession case many times as well. But they did convince me once again, Max, in March and April, and people can roll the tape because of tariffs. But it is phenomenal that the strength of this U.S. economy. If the U.S. economy doesn't enter recession with all of these tariffs, that would, I mean, that would be just uh, a real testament to the strength of the U.S. economy. And the recessionistas will have been wrong 6 times in a row instead of 5 times.
Well, that is something that again, going back to the interviews that I did while you were away, Vincent wrote a piece about like just the lack of recessions over the last 16 years and how that compares to history. There were periods of time in the US history where of the, trailing looking back 10 years, 40% of the time was in a recession. That was like the average. And in the last 16 years, 1% of the time has been a recession. So, clearly something has changed. I guess if you are bearish, like I like to short stocks. It's easier for me to like mentally to say like this is not going to continue than to try and, predict whether this technology is truly going to be transformational. or whatever. So that's just like works for my, personality, probably to my detriment. But like housing, like, okay, so either rates continue to stay high, mortgages are unaffordable, or the economy, crashes. Like neither of those things like look good for housing. Like I'm happy to just keep pressing that bet until I start to lose money on it. But,
Mhm.
like that's if you are bearish on the economy, like why don't you go try and find the areas like because there's always, as you've pointed out, when you talk to these, whether they're recessionistas or they're people, cheering on the greatest economy of all time, there are data points on both sides.
Of
So
course, of course.
instead of trying to like bet on the whole, why don't you just go where the data there's clarity for both of those groups of people? And to me, like that was housing.
Yeah, and Max, I remember when you put on some of your shorts, in last year on housing, and I says, I didn't personally didn't think that they work out, but they really have. So congratulations on a good call there. And I do think that does speak to, valuation does matter. And if a stock is richly priced and it's not growing, or not growing faster than the market in terms of its earnings, that to me is a problem. So for example, Costco or FICO or Wingstop, you know, people who listen to every episode like hyper fans, and I appreciate them very much. They've heard me talk about these companies for a while. Like, okay, if you're doubling your revenue and your profit margins are 60%, like you maybe justify an earnings multiple of 70 or something insane. But if you're growing at 7% a year like Costco, it's like, why is your price to earnings ratio 70? Like, I don't know. I mean, there I actually I am seeing the consequences of Mike's passive argument.
Because
Like
it
that
'cause it's a
probably is true.
barbell. It's a barbell because it's either the economy collapses and we all have to buy everything in bulk to save money, or the US consumer, rides off with bigger and bigger cars and bigger and bigger stuff. It works in
Well,
both scenarios.
Costco is a bet on the rich consumer. Like Costco's, it does cost $50 to be a member, and I don't think Costco's business is immune to the business cycle.
Well, Jack, I think I wanna wrap it up here. Is there anything else you wanna touch on before we go?
No, I think people, can marvel at my incredible tan. It's funny. Like I thought I got a tan, but there is. I gotta say, there is something about this lighting in this room that makes me look paler than I am. So just people should take that into account.
Okay. We'll give you
And
all
also, there's something about the lighting in your room, Max, that gives you a bigger tan. Like I'd say, yeah,
yes,
this can be deceiving.
it's the warm lighting. It's the warm lighting. Well, Jack, it's good to have you back. Excited to have you back in the host chair at Monetary Matters. I know that we've got something recording tomorrow. I believe that'll be your first interview back. When can we expect it out?
That will go out on Sunday, and I'll leave the people in suspense.
Okay. All right, Jack. Great to see you again.
You too.
Thank you. Just close the door.